And maybe the big story overnight, other than Nvidia, of course, were those Fed minutes, which actually came out before and earlier on in the session. And I thought one line was particularly interesting, showing that many officials thought it would take longer than previously anticipated for them to gain greater confidence that inflation was moving sustainably towards 2%. They're still being pretty cautious, aren't they?
They are. Good morning, Joumanna. First time on the news show. Thank you for having me.
Wonderful to have you.
So, yes, they are still being cautious, and that's a good thing, okay? Because we do still see upside risks to inflation. So we do agree with some of the things some of the Fed speakers have been saying over the last couple of days when they're talking about, upside risks. We see, so we've done some research. We're seeing shelter inflation picking up again. And it's because, home prices have picked up quite a bit, actually, since last year. And that kind of predicts where shelter is going. And as you know, shelter is the largest part of, inflation.
Yeah. I mean, I saw in your notes that you had that view towards the end of last year. You thought that inflation was going to reaccelerate.
That's right.
Hasn't actually reaccelerated, but it has been quite sticky, especially if you look at core CPI and the sequencing the last couple of months. What do you think would be the catalyst for it to actually start moving higher again?
So, for one, shelter inflation again, but also I think, commodity prices are still very sticky and high. Plus, we're also seeing wage inflation coming in quite sticky. Yes, we've come down from the peaks, but it's still not where it should be, right? So we're far away from pre-pandemic levels. So everything considered, and we're going to see some tough base effects going forward in the next couple of months. So I think we have a period of a couple of months where we see, slightly sticky inflation. And if the Fed can, hold through that period, I think that would be a good idea for them.
Yeah. So when are you penciling the first rate cut then?
So we had initially thought July because we thought all of this would be resolved by July. But now we're thinking more towards September.
Right.
We do think that the Fed may do an insurance cut here in September because they have other reasons to cut.
What are the other reasons to cut?
So, as you know, the U.S. interest rate, our interest cost is huge, okay? Under the surface, we also have issues with, the economy. So labor is, the labor market is softening quite a bit under the surface. And then we also have, small businesses struggling. Now, I know the Fed is not in a position to, sort of help small businesses and help, the regular consumer. But at the same time, we're seeing record levels of credit card debt, and we're seeing, issues in the economy.
Yeah.
So everything considered, the Fed may think about doing an insurance cut ahead of the election.
Why is that not more of a problem? People always talk about household debt, credit debt in the trillions, the fact that U.S. outstanding debt also is at record highs. And yet it's not really having an impact yet on funding costs or on default rates or delinquencies. Why is it taking some time?
So delinquencies are rising, but you have to understand over the last couple of years after the pandemic, we've seen the wealth effect take over. So a lot of these people, they, refinance their loans. So they have a lot of equity in their homes, and home prices have gone up. So the equity portion has gone up. Stocks have also added about 12 trillion to the wealth effect. And so you have a situation where you have what we like to call the K-shaped economy. So you have the top 25% who are good, who are spending, and there's been a lot of pent-up excess savings, which are gone now. But then you have the bottom 50% who are actually struggling.
Yeah. Let me just ask you, in light of your views, some of the risks that you flag from a financial stability perspective and the fact that inflation is sticky but growth has started to slow down, what does this all mean for investing and where you want to put your money? Can stocks continue to outperform in that environment?
So that's an interesting point, actually. So what we're seeing is stocks are kind of being driven by flows, right? So, and the liquidity in the market. And we think that with the Fed tapering QT, that will usher in some more liquidity here. Plus, as I talked about the wealth effect, that's also another factor. And then you have fiscal stimulus, which is still ongoing. It's not as massive as it was before, but we do see some fiscal stimulus still in the system. And I think all of these can sort of drive stocks. So what we're seeing is kind of a divergence of the way stocks are moving from where the economy is going.
Yeah, well, there's one word that you didn't say that I need to mention, and that's Nvidia. To what extent is Nvidia and the whole AI complex more important for trajectory rate than what the Fed decides to do?
So I think what we're going to see now with Nvidia, so Nvidia's been doing great. They did well yesterday as well. This no surprise. But I think what we're also seeing is the market broadening out. Okay, so last year people were still very skeptical about the AI story, and I think for good reason, because we had this metaverse story before that, and that kind of fell flat on its face, right? And so people were kind of skeptical about, and don't forget, the AI story also takes away from people a little bit, in the sense that people are afraid about losing their jobs and things like that. So everything considered, I think people are starting to adopt the AI story gradually, very gradually. And so we will see this broaden out in the market. And once we start to see that, I think there will be a positive effect of AI on stocks.